Hi there. My name is Aneel Waraich, Executive Vice President and on the board of Steppe Gold Limited. Steppe Gold is listed on the main board of the Toronto Stock Exchange under the ticker STGO. We are a gold and silver producer out of Mongolia, currently expanding into our phase 2 operation while continuing to explore. So what we offer obviously is production, cash flow, expansion, and almost doubling of that production over the next 2 years, while continuing to self-fund our exploration on 2 of our properties.
Aneel, good to see you. Haven't seen you since April. You've been up to a lot, doing a lot, but let's start with the kind of Q3 number update, and then I'll talk about some of the things that are interesting to your investors at the moment.
Yeah, sure. So obviously Q3, we released the headline numbers. Obviously the costs and all that aren't in there as yet, but they'll come out in our financials in the coming weeks. But a big quarter for us. In Q3, our production was about 28%, probably more than 30% higher than our Q2. So we produced just over 10,000 ounces in Q2, well over 13,000, probably over 13,500 ounces in Q3. So a great win to show the market that we've continued to increase production. Production has been stable or better for well over the last 6 months, while continuing to optimize our phase 2 expansion. So we also put out a press release in Q3 about some optimization work for our phase 2 expansion. So late last year, we put out a feasibility study, and we've actually improved on the numbers there. It came in at about $850 all in cost, but what it didn't include is the connectivity to the grid, which now we have an agreement with the government. And by connecting to the grid, we'll save over 10 million US in OPEX in phase 2, or over $100 an ounce. So a significant material event that continues to make our phase 2 expansion more robust.
Fantastic. Look, so well done on that, but you've got downward pressure with gold price. You've got upward pressure from inflationary costs. It seems like you need to run hard to stand still. So when we see these new numbers coming out, are we going to see a net gain, a stationary position in effect, or will there be a kind of loss?
Yeah, no, we're certainly actually making money. Even last quarter in Q2, we produced at site at about $850 and all in with all G&A costs $1,000. So yes, that was higher than our run rate numbers, and that's also because our volume, was only about 10,000 ounces that quarter. On 15,000 ounces, you'll see that cost come down. So we're at 13 and change for Q3, so we expect you can see a similar number until it normalizes over the next 12 months. So our 12-month forecast on about 45 to 50,000 ounces all in, including G&A, is $850 an ounce. So it's a bit higher, including the higher diesel cost and reagent cost, but certainly robust and in quite a big margin. So Q3 will be profitable again. We're building up our cash flow, our cash on our balance sheet, and continue to strengthen that going through the winter, where you'll see some seasonality in production.
Right, so making money, that's good. Phase 1, you're aiming for 50,000. I think this last quarter would suggest you're going to do that. Phase 2, what's the work that's actually happening at the moment? Because you're aiming for 100,000 ounces there, aren't you?
That's correct, yeah. So that's a 10.5-year mine life at approximately 100,000 ounces per annum, which again, while we're constructing phase 2 over the next 2 years, will become bigger and better. And, again, won't require additional CapEx to do so. So we'll be adding more ounces to the mine plan. We'll continue to optimize as we have already on the power. So you're going to see phase 2 look a lot better by the time it comes online. In terms of construction, we've actually already started construction in phase 2. So over the last year, we were able to procure our 1,000 ton per hour fixed crushing circuit, install it, and it'll be fully installed by the end of this month. So that's a big item for phase 2. It's approximately $5 million US of equipment cost and another 3 to 4 million of installation. It's 1,000 ton per hour, 4 times our current crushing capacity, and it'll allow us to actually crush not only some more oxidized material over the next 2 years that we can generate more cash flow while constructing, but it will also give us a head start on building an inventory on the sulfides or the fresh ore below. While constructing, we can build up that stockpile so we can hit the ground running when we do commission our phase 2 plant.
Okay, so you've not raised money for 2 years, which is great. So it's anti-dilutory, but you are plowing a lot of money back into the ground. You're plowing a lot of your revenue, if not all of your revenue, back in the ground in terms of building out for this phase 2 development. So when does the company actually start making money?
Yeah, no, absolutely. So really, the company will really make money in about 2 years' time. when phase 2 comes online. So phase 1 will still be up and running at that time. Phase 2, all the capex would have been spent, and we'll have hopefully a bumper year that year, or that 12 months from 2 years from now, where you have still some oxidized material being run through the leach pad, and you have phase 2 online. So hopefully you have that double, a little bit of residual from phase 1 plus the phase 2. At that point, you're only spending on sustaining capex and obviously exploration. So rough math, on 100,000 ounces at $1,600 gold, you're going to make about $750. So, that's about 75 million US in EBITDA, which is about 1.5 times our current market cap.
Okay, so let's talk about money, if you don't mind. Has the Mongolian government been buying gold off of you? I read somewhere.
Yes, actually.
At a premium as well. Why?
At a premium, exactly. So previous to May of this year, all of our gold sales have been sold within the country to the central bank or the approved commercial banks on their behalf at spot pricing. So no discount anyways. Since May, they've actually been paying a 5% premium to spot pricing for every gold sale. So we do 2 gold sales per month, 2 gold pairs per month, producing, roughly 4,000 ounces per month over the last 6 months. And they're paying a 5% premium, something that we didn't ask for, didn't model. We'll take it. And it has to do, obviously, a lot with what's going on in the region geopolitically. So there's a shortage of USD. And where can you get access to USD is obviously through precious metals. And so that's what we help the government increase gold reserves and help them monetize as they need to build up their FX reserves as well.
Interesting. Okay, so you're solving a problem for them with USD. Okay, that's interesting. What else are they doing for you in terms of helping you in country? Because again, we've talked in the past about people's perception of being able to do business in Mongolia. I think the Oyu Tolgoi project probably scarred people a little bit or skewed the thinking. So what's happening in country?
Well, yeah. So importantly, I think 2 weeks after we released our feasibility study just about a year ago, the government provided a 60 million US debt package for that expansion. So on 130 million capex, almost half the capital was lined up from within the country, sponsored by the Bank of Mongolia. Huge win. It shows you that they're supportive. They want to grow production from precious metals in country. They're not asking for more. In fact, they're giving us capital to grow. We've shown since 2016 that we've been working very well with the government, with the people. We've obviously created 300 jobs today in country, Mongolian jobs, and we're seeing the benefit of that. So that capital allowed us to continue to move phase 2 forward when phase 1 was offline last year because of those supply chain issues. So very supportive government. I think this year you've seen some headline transactions with Oyu Tolgoi now being resolved. Rio Tinto forgiving the bank among the government's debt on the asset, consolidating with Turquoise. Finally, that's been approved as of just a few weeks ago. So that noise that we've dealt with over the last decade is finally going to be gone. And it's showing you Rio Tinto is committed to the country and making a lot, providing a lot more capital commitment in country. So a big win. And then just a few weeks later, Zijin, one of the major miners in China, publicly made an investment in Mongolia. So I think you'll see more of this from majors around the world. They're getting more comfortable with this final, I would say, the final frontier here, where it's relatively underexplored and a lot of opportunity.
Yeah. Okay. Just going back quickly to the Mongol Bank 5% premium. There, are they're paying you in local currency? So there's a question sent in by DJS. It's a big shout out. There you go. They're paying you in local currency. Right. Okay. So that works for you on a couple of levels, I guess, as well.
Yeah. So getting paid for gold sales, local currency. 60 to 70% of our current costs are in local currency, right? We're operating as a local company. We have local contractors, full-time employees, all local. So many things can be done locally. And really our need for FX ourselves, just like the government, are to procure reagents for the current operation and some of the major equipment items in phase 2.
Right. Okay. And so just in terms of your, every time we talk to you, remind me you haven't raised money for the last 2 years. Are you producing enough cash now to kind of get you through to the complete build out of phase 2 and into production and through ramp up of phase 2?
Yeah. So we actually, when we had downtime last year, we continued to mine, crush, and stockpile unprocessed ore. So when we started this year, we had about 85,000 ounces on a recovered basis. So net to Steppe, that's over 65 million US of net cash that we have to convert over time. This year, we've already produced over 25,000 ounces, and today we're at still about 71,000 ounces ahead of us. So on the inventory side, we have about 18 months comfortably of inventory to process, which we've had no issues to process, recover, no operational issues when in production. So if you convert that 71,000 ounces on a rough basis today, at today's gold price, you're still looking at about 50 to 55 million US of net cash to Steppe Gold. So on 130 million, let's just call it 150 million with the power upgrade and inflation and time build, 70% of that or so will be funded by debt. The 30% plug is our cash flow. It's sitting in our inventory, sitting there, right there ahead of us, and we'll continue to convert it and contribute that. And that's our goal here, is to use our cash flow and that inventory as our equity contribution for phase 2 alongside debt. We're very mindful of dilution, and we have been, as you mentioned, we haven't raised any equity for over 2 years, even during the hardest time last year when production was offline. We are owners of the company. Board of management own close to 20%. Our last equity raise was done at more than double our current share price with one individual, Eric Sprott, obviously. And we're very mindful of dilution of our investors, our supporters, our partners, and ourselves. So we will minimize any equity dilution going forward as well for that phase 2 expansion.
Okay, and what other tools do you have in your toolbox? Because you obviously you did that deal with Triple Flag, for less than $5 million, I think, from memory. Will you be doing more of these kind of prepaid type structures? I mean, and just in that context, Mongol Bank or Mongolia government, and more broadly, what percentage of your production are they buying? I'm trying to work out the different tools you've got available to you to kind of get through this.
So 100% of our production is sold within country to the Mongol Bank. So
what's the Triple Flag deal then?
Triple Flag, we have a streaming arrangement. This is from 2017 when we started the company. They helped acquire the asset and build it with us alongside, obviously, equity. So they get 25% of our production today at about 17% of spot. So let's just call it 20% of our current production, just over 20% of our current production goes to Triple Flag. The way it's done is we actually sell 100% of production in country, and then we'll buy the associated credits for gold and silver to offset Triple Flag's streaming agreement here offshore. So call it 80% of our production stays in country, 20% we'll bring offline. That doesn't last forever. When we deliver about 46,000 ounces of gold to Triple Flag, that drops to a tail. So it won't be 25% of our future production. It'll be probably between, we think, 3 to 5% of our production in the phase 2. Because the tail really starts in phase 2. Triple Flag should get paid back throughout the next couple of years of oxide production.
Got it. Okay, understood. And then, so just on the obviously, when we first talked way back when, you talk about this all sitting at surface ready for a moment like this. I'm not sure the market understood or thought that was a smart use of money. It obviously looks smart now. And you obviously are in production. Great. You're going to need to kind of grow this thing beyond kind of phase 2 in terms of, whether it be life of mine or increased production. So what's the ambition and what's the opportunity ahead of you?
Yeah, absolutely. So, phase 2 at least becomes more material in terms of investors, where we have more than 10 years of mine life at that circa 100,000 ounces. So we're kind of getting interesting now. We're getting that scale where investors obviously pay attention. We believe that this is more of a 15 to 20 year mine life. So we've had drilling late last year that has confirmed that all deposits continue to grow at depth. We've only drilled these deposits down to 400 meters maximum from the surface. So this is quite open still. You will go underground at some point. We've had massive zinc and lead hits that are 10 to 20 times higher than modeled in our feasibility study at, intercepts of 10.5 meters, 22 meters, 55 meters, again at 5, 10, and 20 times higher grade. That alone shows you a path to mine life extension. The second thing is we have a deposit sitting there called Mung, right next to ATO4, within a few hundred meters. It's about 440,000 ounces. 400,000 ounces of that is all gold and silver, down to about 400 meters today, is not in the mine plan for phase 2. So we roll that in. So this is without any additional exploration drilling or extensional or new discovery drilling at depth. You can convert that 400,000 ounces as well into the mine plan. That's going to either increase our production profile from the 105,000 we stated for the first 5 years to hopefully 125 plus, or on the back end, keep extending that mine life. So our goal is this will be a 15 to 20 year mine life, we think, by the time we bring it online in about 2 years with what I've just talked about. We'll continue to drill on the property. We're only on about 10% of the mining license today. So there's opportunities for new discoveries, satellite discoveries that can roll into phase 1 or 2, whether oxides or sulfides, while continuing to grow all 4 deposits, which are there and are growing. So we do see some meaningful extension here with, I guess, without a lot of risk per se.
Okay, and just on the heap leach itself, you talk about average grade of just under 1.96, I think. What's the recoverable and what's the payables look like for you
on the heap leach?
Yeah.
So I mean, right now we're modeling 70% on the gold for recoveries and 40 on the silver.
Okay.
We're comfortably within that range easily. Like obviously, the ultimate recovery you actually don't find out for a few more years as you continue. You get about 50% recovery sometimes in the first year, sometimes quicker, which we're finding. We are finding obviously that we have this positive grade reconciliation, which means it's added more mine life to the oxide mine, and of course. It doesn't cost a lot to extract the oxides and process them. So for $1 million in, you get 10 million of revenue essentially. It's a fantastic little starter operation that helps grow the company. We don't know today if we have beyond 2 more years of oxide mine life. That's what we have today. But of course, as we continue to drill out this property, you may encounter more oxides. You can keep feeding it into the system. And without any additional capex. That's the beauty here, of having that infrastructure in place.
Right, and with regards to construction, obviously it's meaningfully advanced in terms of the crusher and chemical storage, etc. And I guess you're building a camp there too. Are you experiencing any issues at the border with China in terms of getting materials in and out? Has that relaxed any, or have you made alternative arrangements?
So when it came to reagents last year, that was the biggest issue. Obviously, that kept production offline because we were procuring from the land border between Mongolia and China. For hazardous materials, that has yet to still open. So that has not opened up as yet. We're hearing by the end of the year. So that would be great because it will lower our costs again in terms of the reagents procurement, which is great, increases our margin again. But what we did last year is obviously open up alternative logistical channels. So anything we need from China, reagents included, we've been shipping to South Korea, and we actually shipped it to Russia, Vladivostok, last year before things obviously hit the fan. And so we've made alternative arrangements for procurement in supply channels that now we have the export approvals, import approvals, the rail and whatnot approvals. So it allows us, if there's any delays at the border for material equipment for phase 2, we could make alternative arrangements. However, saying that, last fall we got that 1,000 ton per hour crusher over the border, the same border that's been closed for hazardous materials. We've been able to get spare parts and a major equipment already. So we don't think it'll be a big issue going into phase 2. The major item will be the flotation circuit. That's it. We're building a tailings facility. Knights Peacehold is doing that. Camp expansion is already underway. So we're not relying a lot on other major equipment, I guess, outside the flotation plant from China. So we don't actually see any issues, and we don't need it right now. So the goal is by late Q1 in the new year, we'll start procuring these larger items. And in the meantime, we get to work on our debt package to expand it to what we need for the full build out.
Right, and well, that's the kind of important leg of this, I think, because you used the word earlier at the beginning of the conversation, was the geopolitics of the region. How is Mongolia positioning itself? Because obviously it's kind of had a history with China, and obviously it's a big trade route as well. And we've seen companies based in that kind of Pan-Asia region broadly, when they're at the point where they're looking for project finance, some of the Western banks and finance groups are not encouraging companies to trade with or sell to the Chinese, to put pressure on them. How's one Mongolia dealing with that kind of sensitive geopolitical narrative, and two, how do you play that in Mongolia as well?
Yeah, absolutely. So, in fact, actually, this year, the government of Mongolia has been working on strengthening that relationship publicly with China. Bottom line is they rely on them. All the exports, whether it's coal, copper, or copper concentrate from Waraich with the precious metals, iron ore, they go to China. So they rely on them. It's the biggest trading partner. In fact, and obviously they procure a lot in terms of consumables and everything else, given that they're a landlocked country that doesn't produce much of anything, rely on China. So they have publicly, the president's gone to China. They've met multiple times this year, publicly made announcements that they're looking to strengthen their relationship, and they do rely on each other for a variety of reasons. So for us, it's somewhere where we will continue to grow that relationship. It's meaningful because for us going to phase 2, we'll be producing concentrates as well. They will be going to China. And obviously, we're procuring a lot of our equipment, like we did in phase 1, and is also in phase 2. We have the low cost logistical advantage of being next to China, where you can get these off the shelf plants and whatnot. So you're going to see continued partnership growth with China and Mongolia, given the reliance on both countries, and it's happened. And that's where you've seen Zijin make that first public investment. They've got the go ahead now. I guess the Chinese government has now got the go ahead to obviously be more public about their investments in Mongolia.
Right, but I guess this important bit is so what does that mean for you as a Canadian company, understanding that you're going to either need to get confidence that Western funders are comfortable with that, or you need to go and raise your money more locally, in the Pan-Asian region. And if so, where are you with those sorts of discussions? And in actual fact, is an advantage? Will you get cheaper money?
So yes, so that's a good point. So one is, yes, the Asian banks are more comfortable in Asia than the Western banks. The Western development banks take a long time. They're there, they're interested. They've backed OT. You've had groups that have invested a lot of capital. You're seeing Mongolia be more strategic for Western jurisdictions, given its location, given how resource rich it is. So it's an advantage to us. But certainly the cost of capital has gone up in Western jurisdictions just in the last few months alone. So we've been talking to lending partners, project finance partners, traders as well because of offtake. So a lot of structures we can utilize between debt and prepayment with offtake for phase 2 and all that. So we've had plenty of conversations, plenty of interest. Bottom line is we're getting the most interest within the region. And yes, the cost of capital would be lower than the Western jurisdictions, and the timing is quicker. And that's a key here. We can't sit around for a year without having moved phase 2 forward where we have the opportunity. So we've already shown the domestic support. We're actually looking from within Mongolia for further support first, and then you have, of course, China next door and other Asian lenders and institutions. So the interest is there. We've been having plenty of conversations, and our goal is, because we have the luxury of time, is continue to optimize phase 2 as we have already a couple of months ago with that power upgrade. As we continue to optimize phase 2 over the coming months, it gives us more leverage in negotiating that package for phase 2. Because we don't need the capital this year, our goal is by the end of this year, or call it at some point in Q1, to have that full package in place. And we have the luxury of a little bit more time, which allows us to optimize and take advantage of that.